The market is all guns blazing right now, 120 points in the green. Manish Sonthalia, the head equities PMS at Motilal Oswal Asset Management, is joining us now to give us his view. Manish, good morning. The market has covered quite a bit of ground from the lows that we hit in the early part of June. Do you think the worst of the selling pressure to do with recessionary fears, inflation concerns are now behind us?
Yeah, so, markets are actually seeing some sort of a short cover rally. And, whether the markets have some more leg on the downside is basically trying to figure out how much of a recession is priced in the US. My reckoning is that, around 70-80% is already priced in, 20% is still left. And, this on the back of some serious correction that we are seeing in energy prices. We're seeing industrial metals come off. We're seeing record inventory levels of gas in the European region, etc. These seem to suggest that, more or less around 80% of recession is priced. On that backdrop, you could see some rally on the upside, but my sense is that you'll be in for some round of volatility between now and September, when the markets will try to factor in for further rate hikes by the Fed, 75 basis point and 25 basis point after that. So there's still 2 or 3 months of volatility that one has to brace up with. But otherwise, around 80% of recession is priced in, and that gives some hope that we are somewhere close to the bottom.
Manish, good morning. The big move in the market has been in the auto space over the last 3 months. What's your view here? Has the market moved ahead of itself, or is this the perfect trade, given the way commodity prices have cooled off? How would you approach it now?
Yeah, so basically, the auto sector has really not done anything in the last 5 years. It has only seen correction, and time and again, when the prices started to move up, you saw fresh round of selling in these stocks. Apart from the commodity prices cooling off, which gives some sense on the direction of margin in these companies, is basically to do with the order backlog. You see, across the auto space, demand is very robust. There are supply side challenges, and my sense is, you'll have 35-40 days of waiting period for any vehicle that you want to buy in these markets. That gives you a sense of the demand. And of course, with cooling commodity prices, it only adds to the tailwind in terms of earnings upgrade that you're likely to see. MHCV space is very strong. You're likely to see very strong growth till about 2024-25. We are yet not reached anywhere close to 2018-19 levels when MHCV volumes actually peaked. Passenger car demand is pretty robust. You have slew of new launches, particularly in the SUV space. That space is buzzing. Tractor would be somewhat of a slowdown this year on the back of very strong growth in the last couple of years. Motorcycles, entry-level segment is doing okay. That is the space which will see maximum disruption on account of electric mobility. But otherwise, you're in for a strong monsoon. Marriage season is good, so even that space is looking up. All in all, auto space is in a sweet spot currently, given the underperformance over this sector over the last 5 years. And so, it's likely to be an overweight sector going forward.
All right. Hi, Manish. Morning. Sounding constructive on the auto space, and that's really been your call as well, in the past few interactions. What about the other sector that's come back to life? That's the FMCG space. That was being ignored, but suddenly, some of those stocks are up between 15 to around 18%. The frontline names, HUL, you have Britannia as well, that's up to around 13%. All this in a matter of 20 days. How would you view this space?
So over the last 20 days, what has really happened is that commodity prices have cooled off massively. What was seen as a massive, margin headwind for this entire space, somewhere there's a silver lining now, suggesting that the worst on the margins, at least in the interim, has been done away with. Significant cooling in of all, commodity prices, petrochem prices, metal prices, packaging material prices, etc. Gives some hope that, the downgrade cycle anticipated in the FMCG space is behind us, at least for now. You'll see some strong pricing growth in the first quarter numbers. Volume growth is going to be likely in single digits, but all in all, top line growth is likely to be healthy on the back of pricing growth. And margins would be somewhat of a, situation to deal with, at least in the first 2 quarters, but at least at the margin, commodity prices are receding. That will give a tailwind to margins in this space.
Manish, this whole consumption space has come back in a big way, right? Whether it's travel, whether it's luxury. We just saw Titan tell us that this Q1 is perhaps the best that they've seen in the last 2 years. Jewelry sales have come back in a big way. What do you do here? Do you put fresh money to work in names like Titan or anything else in this consumption basket that you like?
So consumption-facing companies are facing a tailwind on the back of pricing in of recession as well as cooling of commodity prices. I think in retailing companies, one has to deal with unit economics. Whichever company has their unit economics right, that is to say, store level ROCs, if they are in excess of 18-20%, your cost of capital in the region of 10 to 12%, obviously the spread is going to be good. And there is a pent-up demand. There's no doubt about it. Whether you look at Phoenix, quarter on quarter, 10% up consumption sales, or whether you look at guidance given by Titan or others in the space, the likes of Maneuver or, Biba or, W. All of these companies really are seeing a lot of demand, likely to see exceeding pre-pandemic sales. And of course, all the all the variables on the retailing front are firing. And that is why there is some catch-up trade that's happening in these spaces. One has to take a call on valuation on each of these individual companies and whether the unit economics are.
Okay, fair point. Now, we will have earnings season kickoff tomorrow, Manish, with TCS. What's your view on the large cap IT and TCS in particular?
So quarter numbers are going to be okay. It is, they're going to be strong, particularly on the back of very robust demand. It's all about outlook on margins because margin pressure is likely to be there. And as well as guidance as to how things on the IT spend outlook is there, at least based on our interaction with large cap IT companies, there doesn't seem to be any slowdown in demand per se. It's not about the FY23 numbers that one has to grapple in the IT names. It is about FY24 numbers. The probability of 0% recession in the US or a 30% recession in the US or a 100% recession in the US, and how much of that has got priced in, and what is the space? What are the the clients saying? Of course, in the BFSI space, which is roughly 1/3 of the IT spend that happens in the business that comes to India, except for large clients like JP Morgan, etc., other BFSI names have really sounded of caution in terms of IT spend. So, there is apprehension that, dollar revenue growth for FY24 is not going to be double digits. It's going to be somewhere in the single digits. And that is leading to some multiple compression. Of course, in this backdrop, if you anticipate that, that's what we are believing that TCS is likely to grow anywhere between 12 and 14% CAGR over the next 2 years. One has to figure out whether the valuations at these price points are okay or not, or there could be some compression in valuation, but that's how the situation is currently.
Okay, the market's cooling off just a little bit, by the way, and the reason for that is Reliance. Like I highlighted in the morning as well, if there's one thing which can really sort of put a bit of a cap on the market today, it could be Reliance, because that's the one where you have headwinds now. And there it is now, slipping back below that 2400 mark. Remember that last Friday's low becomes important, and over the last 2 or 3 days, every rally in Reliance is getting sold into. Manish, this really came out of nowhere for the market, right? The government measures, and Reliance was building a nice rally, and that really got punctured. It's the biggest stock in the market. Your view?
So there's going to be earnings cut, for FY23 and FY24 on the back of windfall tax imposed by the government. This MOAMC has large weightage in the Nifty. So there is going to be a cut in Nifty earnings growth for FY23 and FY24. What was anticipated to be something like a 15% earnings growth for FY23 on the back of these cuts are likely to be somewhere in the region of 10 to 11%. So, it all boils down to, in the case of Reliance, as to what refining margins one was building for FY24. Obviously, nobody was expecting these supernormal GRMs to sustain going into 2024. At best, it could have lasted for the next 2 quarters. So, a lot of downgrade in refining margins was already built into, let's say, Reliance's stock price, going into FY24 numbers. This now comes as some sort of setback in terms of valuation re-rating. There wouldn't be too much of a earnings downgrade, but whatever it is, that's having a negative bearing on the stock. Stock does have value given the fact that ARPUs are on the move up. 168, maybe going to 180 soon, as well as the demerger options in terms of retailing and Geo and O2C business. That will keep the stock excited, even though there's some pressure on the stock price because of the windfall tax imposition.
Just one final question from my end then, Manish. The big headline this week was the massive fall that we've seen in commodity prices, right? So palm oil prices are now down almost 50% from their 2022 highs. Wheat prices are down about 40-odd%. And we've seen a big move. I mean, HUL, for example, is the biggest gainer this week. Good moves in Britannia as well. Do you think if someone has missed this sort of short rally, is there more to go on the upside?
Unless and until crude again moves back to $120 and above, I think consumer-facing companies are going to face a margin tailwind. There was a lot of apprehension in terms of margin headwinds going into the future for FMCG and consumer discretionary names. That concern is alleviated for now, and we need to keep a watch on the commodity prices per se. But as I said before, how much of a recession is priced in? My belief is that 70-80% of recession in the US is already priced in. The last bit is starting to get priced in. And once that is done, you'll see the bottom for commodity, the peak for commodity already behind us. And that would act as a massive tailwind. And obviously, consumer-facing companies are really going to benefit out of it. I think that is what is happening in terms of valuation re-rating for consumer companies, including the likes of FMCG companies like HUL and GCPL and so on.
Manish, thanks a lot for your time today. Good talking to you as always. And in fact, your last answer leads us beautifully into our next conversation. Godrej Consumer is in focus after their Q1 update. They expect